If you watch carefully, you'll see compounding growth and distribution of risk in finance, engineering, physics, nature, art, or different places. So these are two principles that give us an unfair upside and an unfair downside. And with unfair upside, I mean that compared to the people that we compete with in the market, because as we know, it's a zero-sum game. So as we're competing with someone, over time and over the trades that we take, we will always have an exponentially higher profit than the people we compete with. So eventually, really soon, because of the nature of compounding, they will not be able to even come close to our profits, because we have a much larger account to trade with, number one. And because we have a much larger account to trade with, we have more space and more leniency to make decisions that people with a tight budget cannot do. So that's number one. And then number two is distribution. So understanding how we can minimize our risk by simply trading more of what works in different environments that fit each other and are negatively correlated. And if we do both things at the same time, then that performance compared to a performance without any of those things is basically uncomparable. So let's get over that. We'll dive right into the first principle and go to the second. So first of all is compounding. We covered this a lot, right? We went over the compounding calculators and so on and so forth, which show us how the compounding works. And 10% a day over 60 days is, I don't know, I think 300x or something like that. And then over 120 days, it's like in the millions of multiples. So obviously we understand that compounding is big. If you don't understand this, then just Google compounding calculator or use the calculator I think that we have on the website actually. Yeah, right here, trading profit calculator. Right, here we go. So daily growth of 10%, starting balance $100. So $100 becomes what, $1,800 over 30 days. Over 60 days, that $100 becomes $30,000. Over 100 days, that $100 becomes $1.3 million, $1,378,000, and over 120 days, it becomes 9.3 million, right? So in those last 20 days, we made like $8 million from the $100 that we started with, right? This is assuming that you have a constant compound of 10% every single day. So you understand the power of compounding. You literally, like, with a $100 investment, you would have close to $10 million. So that is, basically like taking money out of thin air, right? And this is true if you have a constant 10%, or at least a 10% average of compounding every single day. So, easier said than done. However, the principle stays the same. So the closer we get to this number, the higher the compounding is, and the more power we have in the market. Easy comparison, us after 120 days, assuming we traded this, and we have $9.3 million, and the one person is still trading with $100, well, who has more power in the market? The person with $10 million or the person with $100? Simple, right? So this is an exaggerated example, right? Not very realistic, but it drives the point home of when we exaggerate those things, they're easier to see. But they're still true even in smaller amounts when we zoom in more. So this is the principle of compounding, but how do we do this? And I came where I got the idea for this call and topic when I was talking with Alex. And we were talking about the XRP scenario and the plans of what XRP is going to do. That in and of itself is a separate call, maybe a call that he should do as well, since it's his idea. But the idea of XRP really is that it's an old coin, but it hasn't had that large multiple or that large boom yet because of the entire SEC case. Whereas right now it got cleared, and on top of that, all the fractals price action and also the price action of Bitcoin align really, really well to have that big push to $8 to $10 with a high volatility drawdown somewhere around the all-time high of XRP, which aligns perfectly. So that's a whole different story. But in that, he was explaining, or we were talking about, how we can make the most amount of profit in that move. So let me just go to XRP real quick here and explain this. And by explaining this, you will see how the compounding is going to help here. So let's just assume this is our plan, right? Might happen, might not happen. We're just saying that this is the plan right now, is that we'll have some sort of retracement to 50 cents, likely. We can go higher as well. Then we'll have a break of the current high right here. As we have the break of the current high, we'll have a larger move. Let me go to a log scale here. Sorry. Let me go to log scale here. We'll have a larger move. Have some movements around the current high, then the all-time high around $3. I'm a little off with my drawing here, and then possibly have a move up to 11. This is not my plan, right? I'm just drawing something so we could work with it. So here's the idea. Alex calls it the surfing method, and here's the idea of it. So essentially what you're doing is you position yourself for a trade, for a highly volatile trade. So the expectation, especially in a bull run, especially in this situation where XRP is planned, or at least we're looking at a exponential move to the upside. So as we have that exponential move to the upside, well, that is part of the strategy or of the play that we're looking at here. So we obviously want to position ourselves before, and eventually that play will happen, and we'll have that exponential pump. As we have that pump, which by the way for XRP happens very, very quickly. As we have that pump, we now have a large profit, even on spot. We're sitting on a large unrealized profit. So now the question is, how can we use the profits, and how can we use the ideas and the knowledge of compounding in order to maximize our profits as we have this pump? Let me tell you. So we basically break down this trade into multiple trades. The first, let's just assume that we load up at 50 cents, okay? For the sake of this example. We load up at 50 cents, right? So we basically long here. And as we long here, our first clear break that our strategy is actually coming into fruition is when we break the first local high. Because when we break the first local high, we're like, okay, well, we have a bullish move now. We were right. We're pumping to the upside, right? So as we break this first high, we have a confirmation, and basically we can, so our first trade is done of adding in at 50 cents and going to the first high. And as that first high breaks, we're like, okay, well, step one is done. We were right. Now we have a larger confirmation for step two. During that time, at step one, right here, we are in profits already. In fact, we are in 40% profits. So what can we do? We can take that 40% out of the market, or start realizing that profit, and put our average entry to that, so our break-even price, right, our average entry is higher up, right? So let's just assume that we break this high. We put our, where we would have put our stop loss, we put that stop loss at, say, from the current price, if we break it, we put that stop loss, say, 15% lower or something like that. So, you know, we can even do 20%, which is probably here. So we put that break-even price, we take the profits out, and we re-add the profits until our average price is around here, is around 20% from the top. So we basically have a 20% stop loss because we put our stop loss to break even. So what is the result of this? The result of this is that we entered first, we had the profits, we're reinvesting the profits. So our position size right now into step 2 is larger than step 1. However, our stop loss is break even of that entire trade. So right now we are in with a larger amount, but our risk is 0. Does that make sense? Let that sink in. So we had our first trade. We made profits from the first trade. Now we got a confirmation that step 2 is going to happen because we broke the high. So as we break the high and we continue higher, now we have a confirmation of, okay, step 2 is going to happen too. Because if we break that high, the chance that we go to the next local high of, I think, 1.3 cents is very, very high. And that's our second trade. That's our step 2 trade. So to position ourselves into the step 2 trade, we take the profits from the step 1 trade, reinvest it until our average entry is at our stop loss, which in this case would be 20%. And then we put our actual stop loss to that break-even price. So worst thing, we are breaking even here on this situation if we get stopped out, right? However, right now we're in with more. We're in with probably 40% more than we were before. So this move to the upside is now compounding already. Well, guess what we do next time? So let's say we hit this level, we start chopping around a little bit, and then we break higher. Well, now again, we have a confirmation that step 3 is going to happen of the all-time high. So what we're going to do is we're now going to take our average entry and put it 20% lower than where we chopped around. So now we're trailing our average entry higher. And how do you trail your average entry higher? By adding in more higher, right? So we're reinvesting the profits as we go to the upside. And this obviously, the foundation of this move or this idea is that you have a large bullish move, or at least a large trending move to some upside, and it is broken down in multiple trades, and you need confirmations and you need chance that these multiple trades are going to happen, which in XRP looks like that might happen very well because there's so many alignments around it. So step 1, right? We break out, we have a confirmation, we reinvest and put our average entry to our stop loss to break even. Now we reinvest it again, stop loss to break even. In this case, you know, it might not even be break even, it might be slight profit because you're making more money that you can reinvest in order to put that average entry there. And then we just keep going, right? And then, you know, very likely we might have like a big selling event or some sort of high volatility or high volume selling event at the all-time high because of all the people that have gone through it. And then, you know, the move to $6 or $8 is still a possibility. And if you do that, you know, you're basically compounding your 40% on top of your 200%, on top of your 400%, on top of your 100%. Right? So essentially this move, that's 20x. If you compound the right way, and as you can see, we did not increase risk from our initial position, because after step 1, the worst that can happen is break even for us and then slightly higher profits. So that's not the problem. And you are compounding within the steps of the move. And this is where the compounding happens, because the question is when we have our calculator, right? And we're basically saying that every single day we grow 10%. Essentially what we're saying is that it's a 10% growth, but the question is the days, it's how many steps do we have in between where we compound, right? So if you have one trade that's 300%, and you enter and you exit at 300%, you just made, 3x, you're happy. Great. However, if you had 2 or 3 steps within that 300% trade where you exited and reinvested, then you have had 3 compounding events in that 300%, and that 300% would probably look like 400, 500, 600%, 700%, depending on how much you compound. So the compounding effect also within a trade makes a lot of sense. And this situation, or this idea with XRP, is a good explanation of how you can compound within a trade. And by understanding the profit and the risk ratio in trades and how your average entry is being affected by entering and exiting your trade, you can use your average entry as a stop loss and trail it to the upside. And as you trail it to the upside, you are compounding along the way. So you're compounding a lot within a highly volatile move, within an exponential move. So the compounding compounds, basically, right? So that's the idea of it, and this is how compounding works. We know that the strength of compounding. But now, how can we apply it to a specific situation, which we have right now, right? And this situation can also be done in different examples, which we will cover right now. But so far, let me know, guys, if that made sense, or if I should explain this more. Because we need to understand this level so we can move on to the next one. Did it make sense how we can make multiples more in this one XRP trade because we're compounding multiple steps along the way? Hubert, did it make sense? Because as we're compounding, all right, so I might be able to explain this a little bit better. Let's just leave it like this. Let's just assume that this is how the price is going to move for the simplicity. Okay, and let me remove my indicators because they're not relevant right now. We're just talking about how we can trade this move. So let's just assume that we know exactly with a 100% certainty that this is how the price is going to move. 100% to the exact sense right now. This is exactly how the price is going to move. Let's just assume that. What do we do to get the biggest percentage out of this trade? How can we get the largest percentage out of this trade? This entire move from bottom to top is 2100%, 2100%. So basically a 22x on your account. You put in a 1 grand, you get 22 grand out. Not bad, but is it the most profitable way of trading this? You're not allowed to use leverage, by the way, in this situation. How can we make sure that we make the largest profit here? All right, let's calculate it. Someone of you guys, please take out a calculator or open a calculator app and track this with me. Someone has a calculator? Let me know. Someone's ready to type in numbers? Cool. So scenario number 1 is easy. We just write that number down. 2,150%. That's if we just enter at 50 cents and exit at $11.5, assuming we know exactly where the price is going to go. Okay, 2,150%. Okay, so that's option number 1. Option number 2 is that we segment this trade into 3 or 4, let's see, 3 or 4 separate trades. Trade number 1 is going to be from 50 cents until the local high. So let me just put a line here. The second trade is going to be from the local high to 2.45 cents. Here. And then the third trade is going to be from $2.5 to $5.1. And then the third trade is going to be from $5 to $11. 1, 2, 3. 1, 2, 3, 4. Okay. So let's just break this down into these 4 trades and see how we trade with good risk management. But let's see how we trade this when we compound. Okay, so first trade, 50 cents to 76 cents. We make, call it 50%. Okay, so we make 50% now. We put our order right here, and we are up exactly, let's just say exactly 50%. So what do we do now? We can just let it ride, but we have 50% more right now than we had before. We entered with $1,000, and now we have $1,500. That $500 right now is unrealized, but it's extra $500 that we have right now that we could trade with, but we don't. But we want to, logically, because we know exactly where the price is going to go in this situation, right? So it would be stupid not to, right? So what are we going to do now? Well, we're going to reinvest it. Do we reinvest? How much do we reinvest? Well, really, we want to reinvest enough so, assuming that there's a small drawdown here, we want to make sure that we don't hit that drawdown, obviously, because if we get stopped out, that would not be good. We're still in the same trade. What is going to happen to the average entry when we start adding in money? So $1,000, right? We took out the profit of that $1,500. We took out the $500. So it's taken out now, out of the trade. We are in the same exact situation as before, where we have $1,000 in a trade, effectively, right? So what do we do now? We take that profit, we're still in the position, and now we enter that profit back in, and as we do that, our average entry will increase, right? And let's just assume that, well, we have $1,000 in, we take out the profits, which in this case would be $500, and then we want to enter in with $1,500, right? Assuming we can have leverage in this situation. So our collateral, we're talking about our collateral right now, is instead of $1,000, it's going to be $1,500 now. So we take that in, and our average entry probably goes between half, or a little, let's just say goes at around half. Okay, so this is our average entry now. It would be a little better in this case actually, but let's just say that it's half and it's around 20% from where we are right now. So right now we made 50% off of $1,000 that we had in a trade. Then we exited right? With a $500 profit. So right now, at this point, at 76 cents, we have our account balance is $1,500. Okay? At 76 cents, our balance is $1,500. Now we reinvested it, and our average entry now from that initial move is at around half, is around 60 cents. And we're in with $1,500. So the next move that we do now, up until here, we make 300%. So now we make the 300% off of $1,500. Not $1,000, but $1,500. So how much is that? $4,500. So now we made $4,500 off of this move, instead of $3,000 if we didn't reinvest this money. Does that make sense? Because we added in $500 into this move. Because before, it was just profit off of the contract, that our futures contract, but right now we took that money and bought more contracts. So right now we reinvested the money, and instead of $3,000, we now make $4,500 because our collateral is $1,500 instead of $1,000. So this is step 2. So we're up 450% right now instead of 350. Make sense? We'll talk about spikes later. I want to drive the point home of the compounding. So next we have our next move, right? Which is from here to here. How we do, and this is a log scale. That's why the percentages increase, even though the distance is smaller visually, because it's a log scale. So now we can reinvest that $4,500 into our $1,500, right? So now we have $6,000, and we do that all the way until we are down from the entry, until we're down, say, it would have to be bigger now, so let's just say 50% or something like that. So we're down, we have a stop loss, or our break-even price is 50% lower than our current price right now, but we're in with $6,000. So now, instead of being in with $1,000, we're in with $6,000. Okay, so now we have our next move, which is a 200% move. So now, off of our $6,000, 200% move, we made $12,000. So now our account is $18,000 instead of the initial move where we 9x. So instead of $9,000, if we just bought and held, because we did that compounding in 2 steps, we doubled our potential profit. So now we have $18,000 instead of $9,000 because we were surfing it, right? So now the last step, let's just put the average entry lower. Again, we can put it 100% lower, whatever, doesn't matter. So now stop loss is to at break even, right? So we're worst case, we don't lose anything. And our next move is going to be 100%. So that $18,000 is going to double. So that $18,000 is $36,000. So our end result from $1,000 is $36,000. Because we did 3 or 4 surfing steps instead of, what was the original 20, like 20 something, 20x. So instead of $20,000, we now have $36,000. So we made $16,000 more because we were reinvesting the profits at points where we did not increase larger risk, because the maximum risk of the entire move is going to be our break-even price. So the worst that can happen after trade one is that we don't make profit. Okay, so if this doesn't make sense, I can cover it one more time later. But essentially what you're doing is you're reinvesting your profits, and because you're reinvesting your profits, that means that your account size is larger. So those moves later on have a larger significance. So those moves later on make more profit, obviously because your account size is larger. So a 100% move here made you $16,000, whereas a 200% move here made you $4,000. Or actually it's more than the 200%. This is a 230% move. So that one made you $4,000 or $5,000, and this one made you $16,000 because you were compounding. So that is the idea. How do you avoid the spikes? I assume that you're talking about just volatility, and so you don't get stopped out. Well, there is going to be spikes, and we put our quote unquote stop loss like 50% below the price, which is just simply looking at how XRP is behaving. And these are random numbers, in this situation, but we need to make sure that those are not levels that get just stopped out. If you have a 50, like assuming that we have a bull run like this, if you have a 50 or 60% drawdown of a coin, the trend's probably over. If you take out 60% of a market cap of a coin, that's not, unless it's, a $1 million market cap coin, that is not bullish behavior, right? We can look at different situations here. Alex has his fractals on here, so that might be a good situation. But let's just say in this bull run, right, we had a drawdown of 40%, right? But so like if we put our stop loss at 50%, this is again random. It has to be, based on some behavior in the past. But 50, 60%, it's a pretty solid stop loss, right? And that stop loss is a break even. Again, that is the worst case scenario of you breaking even. Anything above that is profit, exponential profit, the higher you go in those steps, right? So if you're like close to your stop loss at the third or fourth step, your profit is probably higher than the full profit of the first step because you're compounding. So this is an example. The reason why I'm covering this is that it's an example of the idea of compounding. I think everyone has seen the chart of Warren Buffett's net worth over the years, and it's like this insane compounding curve, towards now. Same idea, right? The compounding is a large factor in this. The question is, how can we apply this, or how can we add in compounding steps within a move so we profit the most out of it? And for that, first of all, we need to have a clear plan of a move to happen, and also clear confirmations within the move that we're still on track with our strategy, because at any point that can change, right? At any point in any strategy, that can change, and we need to adapt accordingly. So we have our levels here, or we have our situations or behaviors here that if they happen, it confirms our theory that we're still right, that it's still going to go according to what we thought. And that is a good time to have a compounding step, right? So now we covered compounding. Now we covered the aggressive upside, the unfair and aggressive upside that you can have when compounding. Because you're not just compounding in those steps within the trades, you're also compounding in between trades. Because right now, from $1,000, you went to $36,000. So the next trade, assuming that, in a bull run possible, assuming that you have a second trade that has a similar behavior, now you're starting here at $36,000, not at $1,000. So you're going to 36x that $36,000. you know where I'm going, right? Again, these are scenarios. We just drew a line and said, assuming it will go exactly this way, right? For the simplicity's sake of explaining the compounding, right? Going into the actual strategy of how we're going to trade XRP is obviously going to have, you know, a more technical aspect. But, you know, plus minus, it looks something like this, right? But this is not the point. The point is understanding the significance of the steps in compounding. Now, how we apply it is a different discussion that we will cover. But first of all, we need to understand why we're doing it in the first place, because the difference is so large. So this was one example, right? Another great example is actually when we go to the dashboards and even the QC index, right? So we have 5 strategies trading at the same time. And those 5 strategies are compounding. So as they're compounding, they're trading with more and more. That does not mean that in the market, this move from 45K to 66K or 67K within a day, that does not mean that this move in the market was larger than this move or this move, right? It just means that we were trading with more because we're compounding. So any move that as we grow the market or as we spend time in the market, assuming that there's consistent profits over time, the later the move happens, the more profit you actually make in that move. So you could argue that if you have consistent profits, you would wish or hope, which you don't, but like you would hope for the biggest moves in the history of you trading would happen later. The later the better, because as time passes on, your your buying power grows exponentially. So how does that happen? Well, so as we talked about these steps here, right? This is detailed within a trade. We don't do that in the dashboards. We just have one trade. So in this case, we would have the 2,000%, the 20x. And then the next trade that we now trade with $20,000 and not with $1,000, right? However, this happens with 5 strategies. So you still have your compounding events, and you have plenty of them because it's 5 strategies trading at the same time, right? So the question is, like, you have a move. It does not matter how you look at this move. You can look at it like we do on a 4-hour time frame right here. You can zoom in and look at it like this move, or you can zoom in all the way out and just take the first number and the last number of your chart. It does not matter. This is just where the price is going to go. This is just the growth of the price. The question is, how many compounding steps can you bring into the move? And the more compounding steps you can bring into the move, the more profit you're going to make, assuming that your strategy is profitable, of course. This entire call, this entire session is assuming that we have consistency and that we have profitability in our strategies, which we do, right? So we have the dashboards. You can use the dashboards. There you go. You have consistency. Now we can talk about the higher level. If you have a strategy that is not profitable in the first place, you can compound as much as you want. It will just lose more money. It does not matter, right? The foundation to this is obviously having a solid base of what you're building on. But now the next level is like, okay, how can I maximize the profits out of this? Because we're talking about the first principle, which is compounding, right? So how can we maximize this to the largest level? Well, you can surf, like we just talked about. That's the method that Alex came up with, which makes a lot of sense for the XRP trade, right? And you can also increase the amount of compounding events that you have by trading as many trades as you can, right? And then after every single trade, you have a compounding event because you're taking out the profits and then you're trading with more. So that's a compounding event. And because we have 5 strategies trading at the same time, we have a lot of compounding events. So the compounding of the overall account trades happens or grows a lot, because one strategy can benefit from the fact that another strategy made profit. So because another strategy made profit, one strategy can now trade with more money. And now when that strategy is profitable, it just compounded the money from that first strategy. And now the third strategy can trade from the double compounded money, right? So, so the compounding is larger there. Again, as you grow and as your account grows and as your compounding grows, that means that your losses grow too, right? So it's a double-edged sword. So again, you need your volatility, consistency, and profitability in place. Otherwise, you're just increasing your risk. But this is the principle of compounding. And by understanding, okay, how can I compound? Okay, I can add in compounding steps into my trades or into my strategies. And as I do that, the same work and the same time in the market will yield exponentially higher results. That's one thing. And that is the aggressive growth of our profits, which is good, right? And now we're going to talk about the second principle, which is the aggressive mitigation of our profits. Let me give you an example. The QC index right here, this is still 22, but 4 years, like from now to 2022 now, right? The maximum drawdown that this bundle had was 30%. 30% was the worst drawdown we ever had, and we made, thousands of percent, close to 3,000%. So it's solid, yeah. But how is that possible? Well, if you go to the strategies themselves, let me just actually make a second tab here. We're running out of time a little bit, so I will keep this one a bit shorter, and then depending on the feedback of what made more sense and what's more valuable, I can spend more time on each principle. But let's just go to the ETH Turtle, which is the most profitable strategy in the long term that we have right now. You can see why. It's a trend following strategy. If I go to the description, what we see here is, as good as the strategy is, within those 4 years, the largest drawdown that it had was 55%, which is a large drawdown. However, and this is just one strategy out of 5. However, the max drawdown we ever had here was 30%, which is lower. And this is with also 5 other strategies trading and 5 other strategies having their max drawdown at some point, right? However, we mitigated the risk because of distribution, which is the second principle that we're talking about. Distribution means that we take our overall account. We know the stats, we know what we're trading, but then we take the account and we distribute, we move that account or we share that account across multiple instances. So we have multiple chances or more chances that our numbers will actually work out. And this is called the principle of large numbers, or the law of large numbers. I don't know what it is in English, to be honest. But the law of large numbers is that, simple example, if I flip a coin, which is 50-50, right? We can all agree that a coin flip is 50-50. And I don't want to hear anyone saying that it's not. Let's just say that's 50-50. And I flip the coin 5 times. Or 3 times. I flip the coin 5 times. Well, it can very easily happen that I have 3 heads and 2 tails, or 4 heads and 1 tail. Not that hard to happen. If I would try, for like 15 minutes, I would probably get 4 heads and 1 tail. So that's like what? Like 80% heads, right? However, if I flip so right now, because I flipped the coin 5 times, I got 80% heads. Whereas in theory, it should be 50-50, and I would be like, what's going on? This coin is broken because I'm getting 80% heads. I understood the joke. So, okay, but if I flip the coin a million times, now I'm going to get closer to 50% for sure. So now heads and tails are going to be very, very equal because I flipped the coin a million times. So it's not that the first coin was broken. I just tried 5 times. And the other time I tried a million times. So I got very, very close to that 50%. Whereas before, I was at 80%, 20%. Because of the law of large numbers, same way a casino works, right? The more iterations you have, the closer you get to the statistical numbers that you expected. So by having, instead of one strategy, by having 5 strategies that are constantly trading, you have 5 horses in the race instead of 1. So by default, we're increasing the number of trades plus minus by 5, right? So we have 5 times as many trades as we would have before. And on top of that, the strategies are negatively correlated, meaning that they help each other out. So if one strategy is not working, the other strategy by definition, because it's how it's designed, is working, because that's the environment that the second strategy works well at. Whereas the first strategy, that's the environment where it does not work that well. So now we have 5 strategies trading at the same time. We distributed our account to 20% to each strategy. So now the worst that can happen is 1/5 of the worst case that could happen, right? So the max drawdown that we have on our ETH strategy of 55%, right now, it's just slightly above 10%, right? It's 11% on our overall account. It's not that big of a deal now. A 50% would be, because it's just one part of the overall structure. And as all of them are trading, well, what happens too is as the ETH has a large drawdown and is losing, the bully, which has, is based on opposite fundamentals, probably did really well. So on the account, on the overall account, that drawdown, instead of 10%, was probably like 3 or 4% instead of 50% because of distribution. Because we understand, number one, the law of large numbers. So the more horses you have in the race, the higher the chance that you will actually get the numbers that you expect, right? If I tell you that the dashboards make 10% a month consistently, and then you trade one trade, and that one trade has a loss of 5%, you're like, it doesn't work. Well, you traded one trade. The dashboards are based off of, a couple hundred trades. So a year, like a couple hundred trades a year. So if you trade a couple hundred trades and you would tell me that it doesn't work, then that's a problem. If you trade one trade and you tell me it doesn't work, well, fine. But it's the law of large numbers, right? Which, by the way, didn't happen. This is just an example that I'm giving. So by the law of large numbers and by the principles of distribution, we turned a 50% risk into a 4% risk because we distributed our risk across multiple negatively correlated strategies. And we also, because we used multiple strategies, have more horses than the race. And on top of that, after every single trade, we're compounding, right? So we have the compounding effect, and we have compounding events within the strategy, within the overall strategy, within the dashboards, because we're compounding after every single trade. So both principles, you can say that there's a third principle, which is the law of large numbers. All 3 principles are included, and that is why you have consistent results. Because you understand how numbers are formed, how statistics work, and you just apply that. And you can apply exactly this into your own strategy. So how do you do that? First of all, you learn the compounding event. So when you have a strategy or when you have a trade that looks similar to this, or that looks like something that can be highly volatile, then you can probably add in multiple compounding events, right? Or you just simply compounding within your trades. So as long as you have your consistency, you will be compounding well within the trades like we do. Step number 1. Step number 2, distribution, right? So you don't put all your eggs in one basket. You look at different sectors, you look at different strategies, whether that's day trading and investing in low cap AI coins, right? Or it's day trading and swing trading, or it's crypto trading and forex trading. Whatever it is, it's different sectors, it's different markets, ideally negatively correlated, right? So you can take Bitcoin and the dollar, probably negatively correlated, or gold and the dollar, negatively correlated. So by default, you have two opposite movements, which distributes, right? Assuming that both ways you're trading profitably in the long term, but short term, you have more horses in a race and they're negatively correlated. So the chance of a consistent return is the highest or higher. So assuming you have the consistency, right? We're not talking about specific strategies right now. We're talking about the understanding of compounding trade after trade, distributing, trading more strategies at the same time. And then the law of large numbers, meaning that you will not, or you cannot draw your decisions and kill strategies and say that this strategy is amazing and 100% if you haven't traded enough. The statistical relevance of anything really starts at 32, and that's really low already. So if you haven't traded 32 trades minimum, you don't really know how good your strategy is, because you don't have a statistical relevance. So, if you have a strategy that trades once a week, well, that's not great, right? Because you're probably going to wait more than half a year. But what you can do is apply this strategy to different markets, with slight changes, and you can trade this 5 times or 10 times, and now, it's going to be 10 times faster to get to the statistical relevance. What is dangerous, though, again, this is a downside of it, if you just have a scalper or something that trades like 1,000 times a day, you have to look at your slippage and fees, because, that can just kill you completely. So that's one thing, but really the laws or the principles that we're looking at are compounding, the effect of compounding, the effect of distribution, right? Having more or really minimizing your risk by trading more different strategies and knowing your numbers. And then number 3, the bonus principle really is the law of large numbers, meaning that the more horses you have in a race, the more you engage in the strategy or the stats that you're expecting, the higher the chance that you will actually get your end result stats. And these are just the basic fundamentals that anyone that's trading needs to understand, because if you don't, then it will be chaos. You will have trades, you will have results, and you will not really understand why it's happening, how it's happening. You won't really understand your numbers. You don't even know what to improve on or what to cut out, because you don't understand if that is actually statistically relevant. And then when you trade something, you are at a disadvantage of the profits, because you probably had some losses, and then the one time when you have good profits, you don't even maximize them, so it's going to be harder to break even in the first place. So these are very, very important things to understand and learn as you're trading. And it's also the base things that our dashboards are built around, and that's why they can be so consistent. That's why they can trade without us really looking at it. We have not changed the strategies since we launched them. They're the same strategies, and they're trading through all environments, all markets. It does not matter, because they're based on fundamentals. They're distributed, the risk is there, and the law of large numbers is there, right? So I know that this is a little technical, a little hard to do. So if you guys want to, you can add these 3 principles to every strategy that you're trading. It does not matter what strategy you're trading. And you can have them look at least something like the dashboards consistency-wise. So to If you want, whoever hasn't yet, you can just schedule a call with me and we'll go over your specific strategy to see how we can apply these 3 things. I can cut out, some time out of my day, like 30 minutes out of my day, so we can do that. And that's probably going to be the most efficient way to really add in the most value to the people that want it. So if you're watching this on YouTube, there's going to be a link in the description where you can schedule a call and join the Discord. And you guys in the Discord, you'll have a link as well if you want to schedule a call. And we'll go over that. We'll go over the principles, how you're trading, analyze your strategy, and then see how you can distribute it and how you can trade it, possibly auto trade it. Possibly, right? If you're lucky. So that's everything I wanted to cover. This will be posted on YouTube as well, so you'll see it there. And if you haven't yet, I would recommend you to schedule a call with me so we can personally look at your performance, personally look at your strategies, see how we can improve them, and if you're lucky, possibly auto trade them. So that's all from my side. I'll see you guys in the Discord. Whoever wants to reach me, I'll be there. And yeah.